Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all around the world of crypto and blockchain globally. And I have another amazing guest for you today. He is the CEO and co-founder of Fairmint. His name is Joris Delanoue. Joris, welcome to the show.
Hey, hi, Jamil. Glad to be here with you today.
I'm very glad you're here. This is great. I'm looking forward to speaking with you. And let's kick things off. I know I asked the same question to everybody, and I get amazing answers. And it's this: is what is your background, and is it a logical background for what you're doing now?
That depends where you start. Yeah, I've been an entrepreneur since most of my career, like the last 15 years, building companies, and I would say that I am where I was planning to be when I was maybe 15 or 16 years old, which is like very close to Wall Street, very close to capital markets. But at the same time, not to just consume it, but to really change it. And that's the exciting part, I think, in a world that is facing a lot of challenges, macro event, like many things that are happening. Being here in the heart of New York, trying to reshape some part of the capital market, it's very exciting. So for the background, very shortly, and as an entrepreneur, I built companies in Europe initially until 2016 when I exited my last business. And since then, I've been building Fairmint to democratize access to financial upside for a broader range of people. And to do that, we decided to build like what we consider better rails for the equity private market. And by doing that, we are seeing today a big move of like a big technological move to the blockchain technology. And so we leverage that technology to make it happen.
Awesome. And you do that through this open cap table protocol. How do you? And what Fairmint's all about? And then I want to find out more about this open cap table protocol, including and your vision and mission for where you're headed.
Yeah. So at Fairmint, what we do is we bring equity on chain, and to do that, we turn cap tables, which is today most of the time, an Excel on steroids, into a series of smart contracts. And the goal is to move this like boring world of cap table from compliance by intermediation, where you have a lot of players, into a compliance by automation, where literally most of the things can be automated, from issuance. And issuance is most of the time triggered by a decision of the board, an investment done by an investor, by someone else joining the company. So all the issuance part, but then the moment that you start to have people around the table, you need to manage those people. They're all shareholders. And so we also automate this management. And finally, this is where I think the blockchain technology is fundamentally superior to what we knew in the past, is in the fact that we can transfer this equity. We can make it move at a pace and at a cost that is completely new, thanks to this new technology that is the blockchain. And this is new. Like private market are a mess. You mentioned the open cap table protocol. This is typically the kind of foundation that you want to fix the mess. Like when many cap tables of many different companies today in the private market would be managed very differently, over the last 3-4 years, a group of US securities lawyers decided to work on building a standard for cap tables in the US, and that is spreading now to the world. And this is the work that we've been working on and that we took to bring on the blockchain, to make it even better than just an off-chain standard, but to make it like literally fully automated. And so by doing that, yes, we come and we hope to fix this mess in the private markets. But at the same time, by embracing the blockchain technology, we not only fix the mess, we also make sure that we can bridge all those assets with the composability of DeFi. And that is the big unlock, because the moment that you do that, it's a 0 to 1 type of feeling from a world that is off chain with no possibility to easily move the assets, and this world of DeFi where the assets are moving at a pace that is like unseen and unheard in the past. So that's the exciting part, I think.
Awesome. So I want to back up just a little bit. I used to work on Wall Street, right?
Yeah.
I know what cap tables are. I don't know what the mess is, why it was caused, what the source of the mess is. What's your definition of the mess and the current state of it? And what does a cleanup look like to you?
Yeah. So when most of the people look at cap tables from the public market side, and there it's pretty simple. You know, when you go public, that's a moment where there is one class of shares. Basically, it's rare that you have more, and it's pretty simple. The commons are traded, everyone has the same, and then you have DTCC and the whole system that was integrated after the paper crisis in the 70s that is now used, and they use technology to settle things faster now, but overall there is no more mess, right? In the private market there is nothing like this, and you have cap tables with multiple class of shares. Sometimes on top of that you have some convertible securities ledger with another type of assets. You have warrants, you have the employee part. And so overall, it's very complex to prepare or calculate what will be the waterfall, what will be the real ownership at the end. And so this created a lot of issues. Like 2/3 of the cap table that are private came with a lot of issues. Like sometimes it's a law firm that forgot a safe or that put a 0 where they should not. And all those things today can be alleviated by using a mix of technology, AI, and blockchain. And that's how you start fixing most of those cap table issues. The second thing is the cleanup, like I mentioned, it is we need to make sure that everyone talks the same language so that you are not locked in a vendor end, because the big problem that we see, and I like to get back to the history sometime, before you had your share certificate, your stock certificate in hand, that was your shares. Perfect. And then they started to say, okay, let's use the computer, let's switch to a book entry methodology, which make a lot of sense. But that's the moment where, as a shareholder, you start to lose your real ownership and the way you can hold all those assets. But that was still okay. But then with Web2, we started to see vendors in the private markets, that were like, hey, you pay us a subscription as an issuer, and all your shareholder will receive a PDF certificate. You could think it's fantastic, but the problem is that it's not, a beer. And so you end up with something, but if one day the issuer stopped to pay this vendor, well, your PDF worth nothing, or it's deleted. And I think the blockchain technology is the one that will offer back the opportunity for a shareholder to effectively hold their assets. It's a combo of what you add in the paper with the best of the Web2 world without the intermediary that centralized things. No, the ledger see the assets. Your portfolio is actually a wallet where you hold these assets. And your way to always and permanently get access to that, because it's a regulated environment, it's a security, is basically owning your ID. You can do a KYC, and at any time, you will have a regulated agent, like a transfer agent, able to give you back your asset if you lost track of your previous wallet. So overall, I think this cleanup is just like an improvement of what we knew. And I think it's a real opportunity that we can turn this form of ownership into a new collateral, a new asset that you can leverage on other things. And that's the big unlock. That's the big opportunity.
That makes sense to me, actually. So I'm looking at the private market. Private market is massive compared to the public market, right? So
yeah,
you got I used to work at Prudential before it became a public company. So it's a mutual company, but we had to clean up stuff and then in order to become a public company. But then you got the small market, just startups, and kind of like the crypto space, kind of like but then you have the middle market. The middle market's massive, right? So what's your area of the private market is your efforts concentrated toward? And if it is the middle market, then how do you see your solution being able to make Main Street bypass Wall Street?
Yeah, well, I don't know if we'll bypass it. I think what needs to be done now is to leverage the 10 years of crypto industry building new distribution channel. And what was before very centralized in Wall Street is now completely dematerialized on the Web3 world. And this is precisely what we want to leverage with Fairmint. We don't try to create a new walled garden. To contrary, we have an approach where we consider that now this crypto industry is big enough to accept this idea of, hey, let's bring them the protocol, let's bring them the pipes so that they can leverage those pipes to bring new type of assets. And I can tell you a year ago, no one wanted to hear about private equity on chain. We spent 6 years with no one very interested. They were like, yeah, it's the future, but it's boring, or it's too complex, or it's too regulated. And something happened over the last 12 months. We saw a huge increase in the demand. We processed 25 million through our smart contract for the first 6 years of Fairmint, and this year we processed more than 1 billion. So that gives you an idea of the acceleration in terms of adoption, but also in terms of mindset, how people now are thinking like, okay, that's obvious, it's inevitable, so let's not fight this technology, let's embrace it. And so the way we see things is more like Wall Street is what it is. They know their job, they are the intermediaries, but they understand as well that they need to work around this new tech because it's also a new distribution channel for them. They can go anywhere, not anymore just the US market and investor. They can be like worldwide. That's why we saw the tokenized securities working so well abroad, because from a day to another one, they are answering whether they are Kraken, Robinhood, whoever is doing this type of tokenized securities of public company, they're just answering a demand of all those investors over the world to access to these top public US companies. On our end, what we see is at the moment that we are able to say, hey, this top company, like you said, middle markets, a lot of those middle markets 30, 40 years ago would have gone public. They would have done an IPO at 100, 200 million valuation, and they would have been the one making a lot of the retail richer. But today, over the last 15 years, this market was captured by private VC firm mostly that were trying to really like hit some very high valuation before they go public. And I don't say it's good or bad. The reality is that now, after so many years, with IPO being more uncertain sometime, they end up with a lack of liquidity. And we need to bring back a way to unlock liquidity faster, easier. And blockchain technology is an enabler for that. The composability of DeFi is an unlocker. And so all we are doing right now is making sure that we create new rails for those private companies to tap into this new channel of liquidity. And all that we've been building, when I say compliance by automation, is precisely smart contracts that are regulated. There is a broker dealer somewhere that is making sure that those activities are okay and compliant. But at the same time, they just tap into this pool of liquidity wherever they are, without the need of having one or two exclusive intermediaries that operate as the underwriters, that operate as the investment bankers. No, those guys can be part of the answer, but now they have to work with a whole industry that is able to pool liquidity much faster than we ever thought.
I envision the private industries unlocking liquidity. That's great. You know, in a former life, that's good. In a former life, I was and I never really practiced it. I was a certified mergers and acquisitions advisor for middle market. All right.
Yeah.
What you're saying, I'm trying to, and through that lens, you know, how do you think that this type of liquidity would enable M&A activity in the private market?
There are different ways. If we look at what exists today as a solution, when you are not ready to IPO, but you are big enough to have traction, like buy pressure, it is basically you don't have the right rail. So you end up doing secondaries. So some people will come and do an SPV that they will try to underwrite with some institutionals, and that will go through, you know, Web2 platform at best, and lots of phone call where people try to align, and at the end you have an offer that end up on the desk of the board, and the board is saying, oh, actually no, we'll exercise our right of first refusal, and all the work that was done for 3 months is over. Or sometimes it works, but you know, it creates some issues. I think what we need to offer is a way for the boards to say, hey, this is the strategy we want to offer to our shareholders, our employees, our investors. And if you think about it, like the best example was Stripe. A couple of years ago, when Stripe had all this maturity date for their early employees after 10 years of activity, and they were like, oh, damn. They can't lose their shares, but at the same time, we don't want to go public. So we have to find a way. And basically, they had to go through a whole process of fundraising. And we could have done something much different. And this is what we work on now with DeFi, where literally we offer the condition for the board to set the market and to set the rules of this market. And then we offer that to any liquidity provider that wants to connect to it. And we, as tech provider, are able to monitor things. As a transfer agent being regulated, we are the one making sure that the orchestration of the transfer is compliant and should be updating and reflecting on the cap table itself. But then we have a whole world of broker dealers, investment bankers, liquidity providers that operates to make sure that they can come to this market and offer their liquidity in exchange of the asset, whatever it is. It can be directly the share of the company, but it can also be any form of collateralized product based on those shares. And I think that when I mentioned the 0 to 1, that's this type of move that we are operating right now. The world where nothing can move, it's a PDF in your mailbox at best, to, oh, actually I have a portfolio and I have some call to action near this line of asset. This active position, now I can make it work. I can get a loan out of it, or I can put it to participate in a specific pool of liquidity. And I'm sure that whatever is done is already vetted and accepted by the board because they set things up.
Interesting. So the boards over the past decade and a half, at least for public companies, have been, reliant on to do only what the market has told them to do.
Correct.
So now what you're saying is now the boards have a choice.
Correct.
I like that. Hopefully they're smart enough to make the right choice. but
yeah, and they know, and they are the catalyst of all the requests from investors, from the market willing to join, or from the employees willing to, buy a house or pay education for their kids. And so this is also what I consider will be one of the biggest shift for an investment. Like, you are an investor tomorrow, one of the key stuff that you will look at will be, where is the cap table? Is the cap table in the whole TradFi system with a vendor that will lock me up? Or is the cap table in this protocol where I know that this asset will be able to work for me as an investor? And I can tell you, the moment that the investor realized that, the pressure on the companies to use those rails will be immediate, and the shift, the adoption will be huge.
So you said SPV, and I know, I'm not 100% certain. I think the last SEC chair, Gary Gensler, did a pretty good job of killing, was it the SPV or the SPAC market, whoever. So, what's going to be, like, as an investor or as a startup or as a business, what's going to be the mechanism? It's going to be a Reg D filing. Is it going to be, what's going to be the mechanisms from able to get from the company to the investor to be able to invest? Is there, or just going to investors going to give them cash? Like, what's going to be the mechanism and the available products?
So I want all the things that you mentioned are very valid solution to leverage any channel of distribution for a company. The Reg D is the exemptions for the security sales that most of the founders are using today in private markets, and it's very, like, it's fantastic to have this type of exemption because you can do things very privately. That's a Reg D 506B. Or you can also say, hey, you know what? I have a large community. I know that they will need to be effectively accredited, but I will do a general solicitation. I will send an email to everyone, and I will put and advertise my fundraising on the social network. And I will try to bring asset managers as well as retail to my fundraising. And that's the Reg D 506C offering. So literally today in the law, you already, in the US securities laws, you already have all the things you need to do that properly. And you can extend it with the Reg A as well. I think what is missing today is not really the exemption or the vehicle. You mentioned the SPV, the SPAC. I think it's like always, all those things are just like vehicles that you can create very easily. I think what was missing mostly is a mix of education and access to pool of liquidities. And people, investors are not sensitive to what type of vehicle when they want to invest in a company. Why? Because everything is a function of the traction of the business. And that's what many times I had debate with people, when you say, hey, we'll try to unlock liquidity on this market, they're like, yeah, but there won't be any liquidity because no one wants those companies. And I'm like, yeah, but today we have a double problem. We have the fact that indeed a lot of people don't want most of the very early stage company. And that makes sense. It's paper money. It's super risky, except if you are a professional investor or a top angel. this is not the type of market where you want to go. Okay. But the biggest problem is not that. The biggest problem is that today there was no rail to do anything. And the moment that you had a company with some traction, where immediately the market started to be like, hey, I want to be part of that. I want to be investing in this company. I'm using their product for years. Why not? You know, I would have invested in Figma 5 years ago, 6 years ago, if I had the opportunity to do it, but I could not. And I had to wait that it was like billions and billions and billions of dollar of valuation before that I could do something. But what if it would have been easier? What if being on Robinhood, I would have been able as an accredited investor to participate in whatever capacity and whatever type of vehicle into a private round of Figma. Or if I could have acquired from early employees at Figma part of their assets, I would have done it. But that didn't exist. Because it didn't exist, we couldn't access to this financial upside. So it's not a real, the problem is not liquidity. The problem was how to offer liquidity to these companies that are early. And this is what we solve. And I know that everything is a function of the traction. So 90% of the company won't have liquidity, even if they use the best rail, but that's fine. We're not fixing that. We're not bringing liquidity to a market that shouldn't have any liquidity, but we are making sure that we can bring liquidity to this part of the market that deserve liquidity.
I love that. I love that. Let me make sure I get this. So if you bring the rail, you're bringing the rails, okay?
Yep.
To the people, to companies. Their people are going to be able to access early stage company if they want. Early stage company, which they previously needed to go through a VC to get to. You know, there's pros and cons in that, right? So what are the, we talked about the pro, like what are the benefits, what are the drawbacks, you know, of that? Why overall would it be a positive for the industry, for the market, for the entire economy?
Well, I also think that the move that is coming with that is going public earlier. Making sure that, and going public doesn't mean like doing the big IPO, crazy day and all. No, it means leveraging forms of, you know, exemptions to also address that market where you have people willing to participate, and with some clarity, with some investor protection guarantee, because you have a regulated agent in the middle of the game. That is what we promise. That is what we offer, and that we build and fight for. So yeah, overall, financial upside needs to move faster. To make it move faster, you need to offer some better rails to make this private equity move easier as well.
Yeah.
You see?
I do. My only concern with that, it all sounds good, is the financial rails are moving faster. You said regulatory and compliant. That needs to move faster too, right? How do we get that to move faster in accordance with the finance rails?
I think the year proved that the US, as a country, as a nation, they are able to move much faster than anyone else. Okay, like if you think of the last 8 months, 9 months, I mean, it's days and nights, and during that period of time, you know, all over the world for years we heard, okay, US is too complex. This regulation, or this country, or this regulator offers a much better path to liquidity, or path to whatever they wanted to build. The reality is that all the press release and all the thing we read about all those places and location over the last 5 or 7 years have a very, very, very low business today. They have activity, but super low. And at the same time, you see in a few months that when the US decides to move forward, everything is booming. And the size of the market start to be super big. Earlier, we mentioned Wall Street. Well, if I look at how incumbents and Wall Street, TradFi business are embracing the tech, it's like a high-speed train. And everyone is pushing, literally. Everyone is running, trying to do things and bring more. And so we'll see a huge inflow of AUM moving on chain. You didn't see that happening for years in any other country. So to answer to your question on the regulation, I think right now we already have a lot. And that was part of the written input I sent to the SEC Crypto Task Force earlier this year. I don't think we need to constantly request for more regulation or for, things to completely shift. We already have a very strong foundation that we can leverage. What we need now is more like making sure that the interpretation of the law that was written before the blockchain technology exists are applicable or safeguard or under no action letter in this context. Typically, I give you a concrete example, non-custodial broker-dealer. We advocate for that. We think that in this blockchain world, non-custodial broker-dealer are the one that will be so successful that they will guarantee the investor protection without falling into the hyper intermediation that we have when they do this role of custodian. But this law for non-custodial BD exists for the last 15 years. It wasn't used for years. So we don't need to change the law sometimes. We just need to make sure that we leverage what's existing. We can't wait for the regulator and the lawmakers to vote so many bills that your life will happen. And I say that knowing that with Fairmint for 7 years, we've been building this way. Always respecting the boundary, having the US securities laws as our specification for our product. And we saw people crossing the line. And maybe the risk reward was good for them because now some are bigger, some did stuff that made them shift to another market. At Fairmint, we consider that this line was something we didn't want to cross. And yes, we can push for like pushing the boundaries, but we can already do a lot. And what has been done and voted this year, Clarity, Genius Act, who would have bet that 18 months ago? Not a lot of people.
Yeah. I started in this industry in 2017 as an ICO advisor. Every single week, Jay Clayton at SEC made a different statement. So I kept shifting my business, and eventually I shifted my business out of business. So, I'm like, I've been doing podcasting for the past 4 years. But yeah, so I agree with you. That makes sense to me. So I want to, yeah, awesome.
ICO was a very good data point, Jamil.
Yeah.
It shows that the world is ready to finance projects massively when they believe in it. So we can't go against ICOs. Now, the way some people were leveraging ICO was wrong because it came with a lot of abuse. That's when the regulator started to wonder and say, hey, let's find a way to change that. But if we look at what is done now with the new token sales play, CoinList, Coinbase, and probably others, I mean, it is back because people want it back.
Yeah.
And
that was the most.
Yeah.
That was the most fun I had in my life. 2017, that was wonderful. So it's crazy, but I want to thank you very much for your time today for speaking with me. I have one last question.
Thank you, Jamil.
How can people find out more information about you and about Fairmint?
Fairmint.com for the website. They can ping me on Twitter, Telegram, at any time at Joris_DLN. And always excited to talk about what keeps me awake at night. So yeah, happy to chat with anyone interested to dig on Fairmint.
Awesome. Thank you very much for your time today.
Thanks a lot.